Welcome to Mortgage 101, where you will learn the important steps of buying or refinancing a home. Hello, I am glad you are here. My name is Nathan Rufty, a mortgage loan originator with over 25 years of lending experience that has your best interests in mind. After listening to this full podcast, connect with me to discuss your home loan needs. Now on with the show. Hello and welcome to another very informative podcast with Mortgage 101. My name is Nathan Rufty, a loan originator here in California and in Arizona, licensed in both those states. Today, I want to talk to you about a topic that a lot of people call me about to see if it's prudent to take out maybe a HELOC, home equity line of credit, or take the cash out on their existing first. So I want to go over the difference on why going the first mortgage route to refinance and pull the cash out there is better than the line of credit. But everybody's situation is going to be different. So the home equity line of credit, called a HELOC, is a second lien on your property. It's an adjustable rate. So it goes up, it goes down. It's tied to the Fed fund rate. So as the Fed fund rate moves up or down, then that interest rate is going to move up or down as well. So that's one part of it. It's got the index and it's got the margin. That's what's going to move. The index stays, the margin is going to adjust. So once that goes up and goes down, the Fed margin rate goes up or goes down. That's where it happens with your interest rate. It's got a 30-year payment. The first 10 years, you can make the interest-only payments, and then it stops after that 10th year. You got to start paying back the loan over the next 20 years. So it's amortized over a 20-year period because you got to pay it back in that 20 years. So the payment's going to increase. The great thing about a home equity line of credit, it's like a credit card on your house. So if you take out $100,000 and you only use $20,000, then you got $80,000 of that left over to use it at what you wanted to do emergency purposes. But since the new tax bill came out, you're only supposed to use a home equity line of credit towards home improvement or buying another property. So paying your debt off, taking trips, buying a car, financing investment, stock investment. You cannot write that interest off according to the new tax ruling. So that's the disadvantage of the home equity line of credit, is that the tax write-off that you used to have is not there anymore. To pay bills off, to buy a car, you can write that home equity line of credit interest off. You can't do that anymore. So that first 10 years that you borrow that money to do whatever you want with, hopefully it's only to do home improvements or buy an investment property, you can write the interest off, and you only make the interest-only payment if you want to for that first 10 years. You can make the minimum payment, let's say it's $100 a month, you can make whatever you want, more than $100, and it goes to the principal balance. So the home equity line of credit is great for emergency purposes only now, unless you've got a big project you're going to do for the home and you want to pull out a good amount of money, then that's what I want to talk to you about, a home equity line of credit. Typically, if you heard all my podcasts before, the underwrite guidelines will change. They'll change good, they'll change for the worse, they'll tighten and they'll loosen. Right now, the home equity line of credit is 89.99% borrowed up to whatever the appraised value is. So I like to round, it's easy mathematics. If your home is worth $100,000, you owe $50,000 on that first mortgage and you want to pull out up to 89.99. I'm just going to round up to 90% just for purposes here. So you're going to pull out an additional $40,000. So that's going to be 90% owed against that $100,000 property. So you can pull up to that 40. You got to qualify for it, of course, with debt to income ratio, credit, and assets possibly. But is it on owner-occupied only? These do not go on second homes, not vacation homes or investments. These go on your primary residence. So the advantages of a home equity line of credit is you can use it for emergency purposes, which I like. So if you can open up a home equity line of credit just to have it for emergency purposes only, like a job loss. It's an ATM on your open ATM credit card, if you want to call it, on your home up to a max amount. I have one on my house, and it's sitting there. I have to pay a small annual fee to have it open. I think it's $50 a year to keep the home equity line open. But if something happens to me, I can tap into that money relatively easy. I got a credit card and I got checks that I can tap into. It's a mortgage on my house. It's sitting there. If I don't use it, I don't pay any money on it. It just sits there for the first 10 years. Then it stops. If I don't owe anything on it in that 10 years, then it cancels out and closes, because that's an advantage of having a home equity line of credit. It's open for 10 years. That first 10 years, if I draw any money out on it, I can pay a minimum interest-only payment for that first 10 years. And after that, I got to start applying that to principal and interest payments so I can pay it off in that allotted remaining 20 years. So good to have it on your home if you can get it, because the problem I tell people with the home equity line of credit is when you want it, that's the time you're not going to be able to get it. When you don't need it, you go out, I'll get it later. That is the time you need to get it. Just go apply for it. It's real simple, easy a process to get it open, have it on your home, and it just sits there. And if you need it, you'll use it for emergency purposes only, or if you want to spend some money, a small amount of money. And I'm going to go into that a little bit later. So if you want to spend a small amount of money on your home to do some home improvements, then use a home equity line of credit. My rule of thumb is about $25,000. If you're going to take out more and you need to take out, let's say $50,000, it's much better to take it out on a first mortgage, because the interest rate is lower and the interest rate is fixed. And you can write that off because it's on a first mortgage. If you want to pay bills off, if you want to buy another car, if you want to take cash out on the first, all that is write-offable. Where a home equity line of credit, you want to pay a bunch of bills off, as of right now, it's non-tax deductible anymore. You cannot write that off. Only on home improvements and buying a second home or an investment property, you can write that interest off using that home equity line of credit. So if you're looking for a good amount of money, $25,000, $30,000, $40,000, $50,000 to do bill consolidation, home improvements, or whatever you want, and you have the equity up to 80%, on a conventional and FHA, that's the max now, is 80% loan to value. Home is worth $100,000. The max you can take out is 80%. So it's $80,000. Where that HELOC will give you that extra $10,000. So maybe you do a first mortgage and then go get a second mortgage up to the $10,000 just to have it. It's always nice to have. So if you're looking for $50,000, don't do a line of credit, because that $50,000 is a lot of money on a start rate 5.499, or excuse me, 5.49 start rate. That's a start rate. It can go higher on a home equity line of credit. So if you're about $25,000 and you can pay that thing off in 5 to 10 years, then a home equity line of credit is not a bad way to go, especially if you got a great rate on your first mortgage. When I talk to clients, they go, well, I got a good rate on the first. It's like a 3%, but now the interest rates are 3.25%. A 0.25% more to get $50,000 out. Breaking it down, it pencils out way better to redo your first mortgage. Even though it's at a higher rate, the payment's going to be less, it's going to be fixed, and it's going to be structured where you can write that interest off on a home equity line of credit. You cannot. So people get fixated on having that lower interest rate, and they have a slightly higher interest rate rewriting their first mortgage. The payment's lower. So the interest rate you should not get fixated on, because that 3.25% interest rate is a heck of a lot better than, let's say, you at 6% interest rate on a home equity line of credit. I'll even give you the benefit of the doubt. Let's say you're at 5% on a home equity line of credit. That's a heck of a lot higher than it would be at a 3.25%. But that's where you got to talk to your loan professional and sit down and draw out the plan on what you want to do with that money. If you need more than the 80% loan to value, then the HELOC might be the way to go. But you got to look what you're going to use that money for. Debt consolidation is not under the tax code today. Are you able to write that line of credit if you use that to pay debts off? It's supposed to be home improvements. So watch what you spend your money on, and you don't get audit. That's the new tax guideline, is where that home equity line of credit needs to go. I'll reiterate, home improvements or buy other property, second home or an investment property, cannot be used to do debt consolidation, buy another car, pay student loans off, pay for college. It's not there yet. Now, will that change in the future? I don't know, but as of today, that's what it's used for. So if you do take out a home equity line of credit, this podcast is 2 years old. Do check with your tax advisor, because things can change in the tax code. But for right now, you cannot write those things off, only for home improvement projects. So if you're doing a big home improvement project, it might be prudent and advantageous of you to look at redoing the first mortgage, even though it may may be at a slightly higher interest rate than what you currently have, or it may even be lower than what you have. But those home equity lines of credits, they can get out of hand real quick for you, because you can make the minimum payment, great, but you're not touching that balance. Imagine in 8 years, all you paid with the interest only payment that has fluctuated over those 8 years, whether it be up or whether it be down, and you made that minimum payment, and then you got 2 more years left that you got to start paying that principal and interest payment. Well, factor in what the current interest rate is, calculate with the 20-year term left, and then find out what that payment's going to be. It's going to be a lot. When you're ready to refinance, you may not have the equity to refinance and combine those two. And then you got a high loan to value, cash out interest rate on your hands that it didn't do what the purpose it needed to do maybe 8 years earlier. So really look at what you want to do with that home equity line of credit. Talk to a loan advisor and sit down, a good one, and sit down the pros and cons of the home equity line of credit. I don't do the home equity line of credit standalones, only on purchases. We do a first and a second, which is a home equity line of credit. If you're looking for a $25,000 line of credit to do some home improvements, do that. Write it off. You can pay it off shorter than what you can on that 30-year versus stretching that money over the next 30 years. So that's what you want to look at too. If you got you're 15 years left in that first mortgage and the payment's going to go too much up for another 15 years, that you need to stretch it over 20 or 25 years, it's when you really got to sit down and go, how much do you want on the home equity line of credit? What are you going to spend it on? When can you pay it back? Worst case scenario, the payment will be this if you were to do this. So that's where you really got to pencil it out. But I have a home equity line of credit on my home, and it sits there, and and I didn't need it at the time, but when I do want it, I've learned in the past, when I do want it, either they cut the lines out, I don't qualify for it anymore, the home doesn't have enough equity in it anymore to be able to pull that home equity line out. So if you're looking for a home equity line just to have it on your home, then do it. Just spend the few dollars it takes to open it, leave it there, because when you need it, you have it. Whether you need it to pay off bills, whether you need to pay your monthly mortgage payment to keep you going, who cares at that point if it's tax write-offable or not at that point? But you got money that you can tap into to survive versus your savings or checking. Tap into that equity that you already have the home equity line of credit open. So the cons against that home equity line of credit is it's an adjustable. People get complacent and just start making the interest-only payment. They don't tackle the principal at all. The interest rates are higher. The start rates are higher. They can go up and they can go down. There's no prepay penalty to it. You can keep it open as long as you want, pay it off and close it. It does stop in 10 years. So after that 10th year, that closes. Now you got to start paying that principal back. And if you have a high balance and you're on an adjustable rate, you're not going to be able to tackle that principal and interest payment on that home equity line of credit as quick as you think that you want to. And then you may not have the equity in your property to combine that first and the second, where you're going to kick yourself in the butt going, man, 10 years earlier, I should have taken it out all on the first. So a first mortgage is the best route to go if you're looking for any significant amount of money on a cash out to do some home improvements or pay off some bills, which you can write that off on the first mortgage. So if you're looking for a home equity line of credit, talk in California, Arizona, I'd love to connect with you and talk to you about the pros and cons and your financial situation, because they're going to be different from the next person calling me or the other person calling me. Everybody's financial situation is different, and what the purpose of the home equity line that you're seeking on what you're wanting to do. And don't get fixated if you're listening to me in Texas, which I'm not licensed in, but if you're looking for a home equity line of credit, talk to a loan advisor. It might be better for you to rewrite that first, and don't get fixated on that 2.99 rate that you got and you're going up to 3.25. The numbers will pencil out redoing that first mortgage at a slightly higher interest rate than it will be doing that straight home equity line of credit. If you're looking for 10, 15, 20, less than $25,000, home equity line of credit might be good for you. But I'm also going to look at redoing that first mortgage on a 15-year or 20 or 25 years, because you got to look at it in a financial situation that you don't want to give up what you've already done on that first mortgage. So that's where I love to connect with you in California and Arizona if you're looking for a HELOC, a home equity line of credit. Now, home equity loan is a fixed rate, which there's not too many of those out there. There's more of the HELOCs. It's 99%. HELOCs home equity line of credit on a second than it is on a HE loan, which is a fixed rate second on your home. And they are not going to start at 549. They're going to start at 699, 799, 899. Those are just higher rates because they're fixed and they're in a second lien position. So if you're looking for that, a home equity line of credit, talk to me. I'd love to run the numbers with you and make sure if that's the right move for you to do in California and Arizona. This is Nathan Rufty, and I look forward to speaking with you. Thank you. Bye. Thank you again for taking the time to listen to this very informative podcast. Remember to subscribe, share, like, and comment. There is no better time than today to explore your options to purchase or refinance a home. Please call, text, or email me at the information below to get started right away, and I look forward in hearing from you.